Okay, then I think we are good to go. Let's start. Morning, everyone. Thank you for joining us today. We are delighted to host Finfactor's first ever webinar. And I think we have chosen a topic that is sure to generate very interesting viewpoints. Our topic today is: Will AI replace traditional RIAs? AI, as we know, is making inroads across industries, right? And the wealth management industry is no exception. The use and impact of AI is being debated across advisory firms, regulatory circles, and tech-led platforms, obviously. How much of it is hype and how much of it will actually change the practice is what we are here to understand today. And to do that, we have a stellar lineup of guests that will get us all the perspective, the client side of view, the RI view, and also the large institutional view. Before I jump into the intros of our guests today, I'm just going to talk a little bit about the flow of the session today. So the session is planned to be 60 minutes long. The first 45 minutes will be our panel discussion. The last 15 minutes are reserved for Q&A. We'll open the chat for questions after the speakers conclude their discussion, maybe towards the end, so that we can gather the question queue slightly early on. Also, if we are unable to address all the questions live, don't worry. We'll share responses over email after the webinar. Uh, with that, we'll jump straight into the session now. It's my pleasure to introduce our esteemed guests for today. The moderator for today is Mr. Neil Borate. Neil is a Neil is the editor in chief at the Fine Print, and he's a former deputy editor at Mint. He is one of India's most respected financial journalists. He's done great work in demystifying personal finance space, regulation, and wealth products for the public at large. His work often sits at the intersection of markets, policy, and consumer protection. Of course, he brings in deep context in terms of emerging technologies that will reshape advisory and decision making. Representing the RIA fraternity today is Mr. Harsh Roongta. He's also our first speaker of the day. He's a stalwart in India's financial services space. He runs Fee Only Investment Advisors LLP. He also serves on the board and is the former chairperson of the Association of Registered Investment Advisors. He is currently also a governing council member at Sahamati, and he has played a key role in shaping up the account aggregator ecosystem in the country. His expertise spans regulation, financial inclusion, consumer rights, and technology enabled advisory, giving him a unique, holistic view of how AI, data, and human advice will kind of converge. And finally, to get us the institutional perspective, we have with us Mr. Gautam Kalia. Gautam is a seasoned leader in wealth management space. He oversees investment strategy, product distribution, and advisory initiatives at Mirae Asset Sharekhan. He comes in with a very strong experience that blends in research, portfolio expertise, and of course works with a very deep client-centric mindset. He has worked extensively with digital tools and hybrid advisory models at scale, making him an important voice on how AI-driven efficiency and human judgment can complement each other, right? With that, I'm going to hand it over to Neil now to start today's discussion. Over to you, Neil.
Thanks, Likit. Hello, everyone. Welcome. So today's topic is one of those great debates that of our time that will shape how the profession pans out in the next few years and the broader financial services industry. But it's important to first take a look back at what has happened to RIAs, to advice in India. And then once we have that context, we can talk about what might happen. If you look at the past 5 years, the role of RIAs has actually not grown much. It has, in fact, diminished. The numbers say so. There are only 450 active RIAs in India. Um, Strangely enough, the number of MFDs has also not gone up. It has gone up a little bit. We have about, I think, 1.5 lakh. Gautam can correct me on that. But if you look at the number of investors, that has tripled. If you look at the AUM of the mutual fund industry, every other number has doubled or tripled. Just the number of intermediaries has not gone up much. And the reason for that is quite evident now. It wasn't evident to me back then, but it is very evident now that the default mode of investment of the average investor is Number one, get free advice from YouTube. And number two, execute that free advice for free on a discount broking platform. And that thought process had taken hold so much, has gone to the roots of society, that it's very, very difficult to break. So RIs, in my view, cater to maybe the top 1% of society who uh, can't afford to make mistakes by taking YouTube advice. And therefore, it's not easy to for AI to disintermediate, or to take away that market share. But now let me bring in both of our panelists first on the overall topic, and then we get into more sub questions. So if we can start with you, Harsh, given all of the historical context, do you see the RI business more at threat, or is it more what's happened on social media that may end up being disrupted?
I think it is a bit of both. It's going to change. I mean, and it is changing as we talk. How people consume advice, whether from licensed advisors like us or from the Wild West advisors that exist on social media. I think it's clearly going to change. AI is going to change a lot of things because advice is never consumed in isolation of what the needs are, and as the needs evolve, as the needs become more sophisticated, I think we will see big changes happening. And we've seen that already happening. One aspect of that you have touched upon, okay, which is the fact that licensed investment advisors or licensed financial planners, that's the word I would like to use. Licensed financial planners have probably not increased. In fact, they have decreased, as you pointed out. Uh, at the same time, we've seen a proliferation of social, advice, financial planning advice coming in the social media. Uh, I think both are going to change. It is going to change the social media people as well as the licensed financial planners, and not necessarily in the same way. So very clearly, it is going to change both the parts of the advisory landscape.
All right. Gautam?
Yeah, I agree with Roongta ji. Change. We can see that change is happening. Uh, what we need to recognize is that there was a clear gap in the market. There was a clear demand for a hunger for information. Right? There's no financial education at the school level in growing up, and there is this massive gap that social media helped fill. Not everyone has access to Harsh, right? And that's really the problem that I think social media and the experts on social media have tried to address. And because of that, they've introduced basic financial planning and general financial planning advice to a lot of people, and that that has become, like you said, Neil, the default model. Now, as people become more serious about their money management, and they start really understanding that they're missing the forest for the trees when it comes to trying to avoid paying for advice, that's when they'll start to look for professional help, right? And you'll always have the spectrum of people. It depends on the individual behavior. So you have the spectrum of delegator on one end and DIY on the other. So obviously the DIY guys are the first ones to adopt the approach, whether it is social media, whether it is AI, whatever it is, they will try to look for sources of information that will help them take these decisions on their own, because that's how they are built, that's how they think. While the delegator mindset, or someone who's not entirely DIY, will always, hope to look for someone who can advise them. I mean, you have similar analogies that you can look at even in the medical space, as things become more expensive, there are so many people who prefer to self-medicate rather than investing time and effort in going to the doctor. So really, it is a function of many things that this has become the default model, and a large portion of our population is on discount brokers and consuming social media. But then, for example, the 15 days in COVID lockdown, the first 15 days of the second half of March, uh, those are the times when you need an advisor, right? For sure, where evidence clearly points to where advisory or having someone on your side who can, without emotion, be able to provide you some advice and tell you to stay on, which a lot of direct investors probably didn't. And those are the things, those are the instances where people over time will understand and recognize. But having said that, that change is going to happen. You can see the regulator already making, regulator moves slowly but surely, right? You can see the fact that we've seen so much uh, happening on the education side, right? Financial education under the garb of financial education, recent case in point. So those things will keep cropping up. Those decisions, judgments will keep coming up, and gradually people will understand that it's always makes sense to go in for someone who's registered, who's where the laws are applicable. And you will still have people who will continue to you know uh, work on the free side. But I think gradually more and more people will understand that it's not a sustainable model, not just for them, but for the provider as well. So I think gradually people will understand that they'll have to make their peace with that, saying that either you have to get onto some sort of subscription, or regular mutual funds, or uh, through a RI with fee structure.
Yeah. Actually, on the positive side, one way in which AI is actually helping the ecosystem. So I notice this on Twitter, especially when some influencer comes up with some ridiculous clickbait post, people ask Grok that is this true or not? And more often than not, Grok will tell you that uh, this is incorrect factually. And I really hope that something similar can be done on YouTube with Gemini and all of the other models. Um, but on that note, Harsh, coming back to you, do we have a cost problem as well? I mean, so far I've focused on the demand side of the equation, but when you think of all of the compliance costs that you have to deal with, can you even offer advice below? I'm going to take a figure out of thin air here, but not a crazy figure, below 50,000 rupees per year.
So, yes, I mean, very clearly, costs of providing advice, and which is clearly not visible to the end user. Okay. And what I would like to sort of take is an example. Okay, and let's take a travel space example. Okay, uh, what is the role that a travel consultant plays in today's world of easy availability? You can find the best, flight options, best hotel options, best package options, etc. Yet a travel consultant plays a big role, and the biggest role, and I'll come to your cost question, but just to sort of explain it, the biggest role that the travel consultant plays in is trying to find out where you want to go. Is that the, because why do you want to go? So even if you go to him, ki, I want to go to Europe, or a particular city in Europe, I want to go to Vienna. Okay. Okay. What do you want to go to Vienna for? Okay. I want to visit the opera there. Okay. So you're interested in music. What kind? My point is, you will find, and there would be other constraints, right? This is my budget constraint. This is the number of days constraint, etc. The travel consultant would act. And what is your other idea of going there, spending time with the family? Now, the travel consultant will help you think those through, right? And then say whether that, okay, for this is a package. Now, once you know why you want to go and where you want to go, okay, maybe the information availability, okay, is very, very good. And maybe that is something the client can do on their own, or again, even there, when you are getting in, you will suddenly realize that, oh, instead of staying in Vienna, if I can stay outside, okay, I can do better, etc. Again, the consultant plays the role even when the fine print is being done. I mean, fine print is the name of your organization. So very clearly, I think all this is cost. I mean, for the consultant, for the travel consultant, and now imagine that the travel consultant is constrained by a number of regulations in what kind of advice he has to record. Every advice, he has to give rationale for every advice, and those are for the protection of the end user. So you can't really argue against them. Some of those regulations may have outlived their usefulness, and those should go, but a lot of those regulations are meant for the final person's advice. Now, overall, okay, if you see, the end user is not concerned with the cost of regulation. But when it starts affecting quality, and some people, invariably, the early adopters will use this travel consultant and they will have a better experience. And therefore, they will be the evangelizers who will sort of bring other people into the fold. Ki, don't plan a trip without talking to a travel consultant, right? Now, the issue with the analogy that I used is that, travel is probably a one time sort of a thing. It happens quickly. The good experience happens quickly. In financial planning, that good experience is going to span over decades, and by the time, it comes back saying, oh, don't ever try this without a financial planner. I think it will be some time. So very clearly, I think the regulator will have to push this. And for the regulator to push this, there will be various ways in which the regulator can push. One, of course, is reducing the cost of compliance, which today is very, very high. And in fact, it is prohibiting the growth of the profession. Second, what the regulator can do and is already doing is to look at the bad actors among those who are not not licensed, take action, which they are doing very clearly. And third important thing that the regulator needs to do is to inform, because the regulator has a lot of inherent credibility. And that credibility, when they use to tell people that, what, don't try this without a consultant. I think if they do these three things, two of them they're doing. I mean, it is slow, as you said. Okay. The regulatory costs are coming down, and hopefully they will come down further. Okay. They are taking action against unlicensed people, at least the bigger ones they should take action against. Okay. The third thing is the other thing that they will need to do, which is to tell people that without,
Mm.
using financial planners, licensed financial planners, they will be at a
Yeah.
disadvantage. They will be at a great advantage if they use licensed financial planners.
Yeah, a campaign a bit like mutual fund sahi hai, which talks about RIA sahi hai or advisor sahi hai. Okay,
Absolutely.
I like to come in
okay.
on the cost part, Neil, because
Sure, sure.
I have a different view. I think like from the 50s or 60s, people have been selling LIC policies pan India. They make, you sell a 1 lakh policy, you make 40,000 rupees in the first year, right? Or maybe even 50,000 rupees. So you have the insurance industry that is growing rapidly, that is encouraging, uh, you know, adoption, client penetration, and there these issues of cost don't really come up as often, right? You have the real estate industry where you have a thriving broker economy, There the issue of cost doesn't really come up. Okay, that's not really regulated. So place uh, where there is a attempt to grow from a organized perspective, right? That place where financial planning, where you're looking at all assets of the client, there if you continue to view cost as a deterrent and think that okay, lower cost will probably lead to greater adoption, I think that that mindset, that approach, there is a flaw. And you yourself said, for example, 450 RIs. So someone like me, with 20 plus years of experience, if I want to go back to my hometown in Dharamsala and set up a RI plan, it's not viable for me, right? Because I'll have to look for clients who have larger assets, or are willing to spend a serious amount of money. Otherwise, the opportunity cost for me to leave my job is just too high. And there are a lot of these factors that prevent good quality advice from being able to reach out to a lot of clients. So I think cost, while I agree that okay, AI can help bring down costs and let's say lead to hyper personalization,
But
advice at
Gautam,
scale.
if you could outline for us also the cost of distribution, because even distribution has costs, right? It takes time with a trail commission to have
Absolutely,
several years before you're able to. So,
absolutely.
can you
Yeah,
give
yeah.
us an idea of the economics of it, industry-wide?
Yeah,
Normally, how much does
so
it take?
most at an industry level, especially if you look at the distribution side, any mutual fund, PMS, AI, third party product business, they're operating at 0.5% to 1% margins. That's the typical range that they're operating in, uh, depending on their asset skew, their product mix. And if we keep focusing on reducing cost, then large businesses will have to figure out ways to cut corners, change their product mix, become more reliant on other products that are giving higher margins, uh, increase conflict of interest, when it comes to their relationship with their clients, and in a way threaten the fiduciary nature of the relationship. So I see this cost conversation still makes sense if we are, let's say, in an economy where 8 to 10% is fantastic returns, right? Then maybe 0.5%, 1% makes a big difference. But where typical equity mutual fund portfolio is giving 15 to 20% return over the last 5, 10 years, uh, you know, worrying about, let's say, 1/4% or 0.5% cost right now, I think is detrimental to the growth of the industry. With AI coming in, I think it is definitely going to help reduce costs at the advisor side, as well as the distributor side, right? Because a lot of the activities can be outsourced. So a lot of the green time of the RM can be improved. So if you have a,
So,
let's say,
Gautam, are you seeing that tangibly happening in your company? Is AI
yeah, yeah,
bringing down? Yeah.
absolutely, absolutely. So, for example, this year we used AI to train our teams. Right, we launched life insurance only now this year, early this year, and we used AI to train our teams on how to sell life insurance products, how to talk about life insurance products with our clients, and that was completely done via AI. Right, you still needed one person to operate the AI, but we'll get there where we won't probably need that. And this 2026, the plan is to have all training completely managed by AI, not just life insurance, but all products, right? So the training cost to a large extent is going to be managed, on by AI. The next step post that, which we are already in talks with and the use case is being tested, is have a virtual assistant for each RM, right? So if you have a AI assistant with the RM who's, let's say, accompanying the RM to all conversations with clients, who makes minutes of the meeting, who sets up key action points, right? Who probably scans the in-house view and research view and provides, let's say, a short list of the products, further short list of the products. So, for example, in mutual funds, you've got 4,000 schemes. Out of 4,000 schemes, every month we at the HO level provide 200 schemes, right? Saying that these are the schemes we like. And the assistant then looks at the 200 schemes reviews the notes, keeps in mind the conversation, and further shortlist, saying that, okay, since you were talking about multi-asset, these are the 5 schemes, shortlisted in the multi-asset category. So we are looking at improving the green time and productivity of the RMs through AI for sure. So that is clearly happening. At the same time, clients on the other side are, well, this is not really relevant to the cost point, but since I'm talking about the AI assistant, clients on the other side are using the what is called the MCP, the model context protocol, which we've launched as well, which is essentially a way for you to look at your portfolio. Today what a client does is takes copy paste the statement and puts it into a chat GPT, right? So we've launched a way for them to do that directly while just being on chat GPT, and being able to access their statement while being on chat GPT. So clients are anyway doing that, using AI to figure out, but clients don't know how to write the prompt. They don't know exactly what to ask for. So if the wording is wrong, they ask for something, they'll get an answer which they'll believe to be something. So for example, you want to invest in an ETF, right? And you say, okay, which is the most popular ETF, right? You'll get the most traded ETF. That may not be the most suitable ETF for your requirement, but you'll get the most popular ETF from, so it all depends. So you'll get, let's say, advice from AI right now, which the clients are also using, which kind of acts as a problem for us.
Gautam,
Because
this is exactly where I wanted to come in actually, right?
yeah,
I mean, can AI come in and do this, wherein it says, oh yeah, this ETF may not be suitable for you because the AI can be fed with that intelligence, right? That's where the whole debate comes in. Will an AI replace an RIA? So
no,
the moot
absolutely.
question comes to that, right? At some
So
point, it will learn enough to maybe advise in a very
absolutely.
personalized manner.
So
I think
yes, please, sir.
So I think the bigger question is not an instrument, because if you know what instrument you want, if you know where you want to go, okay, then maybe AI or the data itself will sort of put together in an intelligent form will help you go. I think a bigger role that advisors play, and where AI can actually make them more effective, okay, is in eliciting what the client wants. Clients don't always know what they want. I mean, this is a fact, right? And you pick up any profession. You pick up the medical profession. You pick up the legal profession. Travel we spoke about just now. The, I mean, we see it. I don't know. I mean, we see this like, client after client. Okay, people just don't know. I mean, आप पूछिए उनसे कि कितना पैसा बनाना है, सबको ज्यादा पैसा बना, ओके, क्या
Yes,
करोगे ज्यादा पैसा बना के,
yeah.
ओके, पता नहीं, अच्छा कितना पैसा बनाना है, ओके,
How much is enough?
they
Yes,
don't know. Okay. And I don't know. I mean, of course, AI is now talking of, general, general intelligence, and, which will have empathy, which will have everything. And, what technology can deliver, one does not want to sort of presuppose. But at least what exists today, right? Where this typical human quality of getting to the base. Okay. So, I mean, the portfolio analysis comes much later. Okay. And what do you portfolio do? You just give them your mutual fund portfolio. What happens to this huge, real estate that you have? What happens to the huge, re- uh, whatever else, SGBs you might hold, some shares you might hold, okay, a stake in a, partnership firm that you have. Ultimately, what some you want somebody to do is to look at it totally, and that's where, of course, account aggregator helps, at least to the extent of all the items. But all the investments in the regulated sectors, it helps, okay. But the fact remains that for somebody to take an overall picture, okay, is very important. I think clients are realizing it. It takes time. Clients are realizing, okay. that it is better not to show just a small picture. So you decide. Do you want to go to a doctor and tell him, I have this cold, please treat me for the cold? Okay, don't worry about other issues that I might have. But your cold is a part of your body, right? It is part of your whole setup. So you never treat a cold alone. You treat a person. I think same thing applies to people's lives, and their lives are not just financial lives. So portfolio तो financial life का भी छोटा सा और सिर्फ financial life नहीं होता. I mean, there are so many examples galore where what makes financial sense people don't do for very valid non-financial reasons. And if you don't understand those non-financial reasons, your planning is going to fail. Okay, I mean, I'll just give one last example. Okay, I mean, I had this client, and this was very early on in my practice, and he wanted to buy a house. He had the money. We did all the planning. We said, you should buy it right now. He would say, yes, 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 but never buy. So, we kept asking him, why are you not buying? Please buy. Okay. He would, keep demurring. Then one day I had a conversation with him. Now, this client had married late. He was about 34, 35. He had just married. His parents had their own house. He was staying with his parents, but parents were dependent on him. Okay. And he said that my parents are very insecure about my late marriage. Anyways. Okay. And now if I buy another house, okay, they will become even more insecure. I don't want to make my parents insecure. Now, is that a valid reason? Okay, of course it's a valid reason. Okay, for not buying a house. But the cost of making your parents insecure, okay, makes that decision completely in favor of not buying. And that's a very valid cost, right? Not taking those into account. And I don't know which AI will be able to elicit this information. Okay. Now, this requires a relationship, it requires a trust with the client. And this is not an isolated example. Okay. I mean, people tell me, oh, this you were able to do because, you have this relationship. I think what the AI can help do is it frees up the advisor to be able to do these deep things with their clients. Enough clients will realize, okay, that this has a lot of value. Okay. And what helps, again, as I said, the regulator can really help by doing those three things: take action against unlicensed players, reduce the regulatory cost. What I meant was reduce the cost of complying with the regulation, remove unnecessary regulation, outdated regulation. Okay. And third, most importantly, have a campaign where the regulator says that it is in your interest to take advice from licensed planners.
Very well put, Harsh. Um, I want to spend some time on another area that's related to AI that is transforming wealth management and finance more generally before we head to the questions. Gautam, I want to bring you in on that, which is account aggregator. So today, the way that the system is set up, only entities directly under SEBI are allowed to use account aggregators. So PMSs and RIAs and so on. Do you think that this leaves out the vast majority of financial intermediaries in the cold and also their customers in the cold because neither of them is getting the benefit of account aggregate?
Yeah, so see, it is a start. It is a great step in the right direction, right? The fact that the regulator recognizes that clients would like a one view of their entire holdings across, XYZ institutions. And as that definition of FI, financial intermediary, is expanded and more inclusive, that also is a function of our digital infrastructure and the way we record data at scale. Obviously we are far away from, let's say, putting in real estate, as an asset class, which real estate and gold are the predominant asset classes for clients, right? So you're kind of kind of not really addressing the core problem. But the point is, it's a step in the right direction. It is the great foundation on which the other things can be built. So I think it's only the beginning. Uh, and Obviously, we can already see the green shoots in terms of our conversations with clients. The type of conversations now are much more sophisticated. I still remember, I also would like to share one incident where, a client is talking to me. I'm representing ING Vesya Bank to a client. Sorry, I'm representing HSBC to a client. I was with HSBC then, and the client also banks with ING uh, Bank, and he's got only debt with us, right? And he's in his 80s. He's saying, I'm very conservative. I don't have much. I've just got maybe a few stocks here and there, but otherwise predominantly debt. So he had 4 crores in debt mutual funds with us. And then after 3, 4 meetings, he became comfortable enough to share his data that he had these few stocks that he had with ING Private Bank. And it turned out he had 6 crores worth of stocks, through ING Private Bank, of which 3 crores were in 2 stocks, right? So that kind of changes the entire conversation, uh, right? And that's really what we've had to deal with over the last 20 years. This is just one of many examples, right? So at least to a large extent, the account aggregator is going to help solve that problem, right? Where the risk appetite or the profile of the client completely shifted basis that piece of information. Uh, so yeah, I think what let's say even Finfactor is doing is a good way to help us implement this and take this forward. From a policy perspective, I think it's far off, but hopefully we'll get there one day where we are able to incorporate real estate as well.
If I may add, Neil, I think
Yeah.
the key thing is that when account, please, we have to remember that account aggregator is a unique concept that we have sort of invented, you can say, in India. This, a consent manager that is able to record consent, that allows the citizen to be able to revoke that consent at will, okay, and understand before they give the consent. And all this is recorded, okay, by an independent party. And the data goes straight from the institution to the person authorized by the client, right? I think this is a huge innovation that India has pioneered. It is still, I mean, the account aggregator is still working at probably 20-25% of its capabilities. And even at that scale, when it is working, look at the impact that it has already had, especially in the lending industry. Okay. And I think replicating that impact, as the coverage becomes more, replicating that impact in the planning industry is really going to change the face of India. Coming back to access, okay, now of course, when it was coming, it was a regulated entity under RBI. It still is, but now we have the Digital Personal Data Protection Act, okay, and there is going to be a data protection board soon. And one of the my understanding of the DPDP Act, it's complicated and there are far better people to talk about it. But my understanding is that the citizen has a right to access their own data. And then, of course, once they have a right to access, they have a right to share that data with whosoever they want. Okay. Now, I think that is what the law provides. The guardrails are still being worked out because in India, please remember, most people don't treat data with the respect, even their own data, we don't treat it with the respect that it deserves, right? And then, when somebody misuses that data, then we cry hue and cry saying, where were the regulators, etc. So I think the current
No, but Harsh,
guardrails of,
just a quick, yeah, just a quick counter to that. So even today, if a client wants to share the data with any intermediary, whether they are MFD or RIA or something else, they can do so, right? Uh, MF Central, for example, was the most common route for fetching data, and we put a stop to that recently. So it's about friction. So even after DPDP Act, I think customer can always download his or her data. Right now not enabled by any account aggregator as far as I know, and Likhit can correct me. But eventually that will become reality of self access to account aggregator and then sharing with whichever intermediary you like. But it introduces friction. There is that whole process. Um, and that was my sort of open question, that therefore should the regulator reduce that friction, bring in safeguards so that there is wider access to account aggregator.
So it's coming, Neil. I mean, it is required to be, that friction is required to be reduced. The citizen has every right. I think DPDP Act clearly recognizes that the ownership of that data resides with the citizen, not with the institution, right? And therefore, nobody can prevent an owner from getting access to the data and sharing it. Of course, it needs to be done in a manner that, the owner is not put to harm. Okay. So, I mean, some amount of, I don't know what those, how it will eventually work out, but very clearly, access getting democratized is clearly on the cards. It will have to be, because that's what the act provides.
Absolutely. Uh, we are almost at the time of questions. Before I move to that, though, Likhit, any thoughts on account aggregator specifically and how it can be democratized further?
Yeah, I think, self-consent seems to be the next logical step, right? Like you mentioned, the friction obviously needs to be removed, but there also needs to be guardrails around it. We don't want data being misused because, see, it's very powerful, right? The amount of data that you can share, MFC, for example, will only allow you to share mutual fund data, but account aggregator that way is supremely powerful. It goes beyond MFC, it goes to stocks, banks, your ETFs. Everything that can be done digitally, I think, can be shared. It's only a matter of time. The industry is clearly awaiting that to happen. We look forward to it. So let's see how it goes.
All right. So for the questions, yeah, we've got some in the comments. I'll just go through them then one by one. So the first question is that, do you believe that we are in an AI bubble? And if so, how can RIAs hedge against it? Um, Harsh?
Yeah. So if I can come
Sorry,
in,
Gautam.
maybe
Go
can
ahead. Yeah,
respond.
yeah, yeah.
So I don't think we are in an AI bubble. I think as we speak, there are a lot of use cases, that proof of concepts that are, taking place at different organizations. Everyone is trying to see how best we can use AI. And in the next 2, 3 years, we're going to reach a stage where everyone is AI enabled, right? It's essentially like the way we had computers come in. I think that's what AI is like. It's just going to become par for the course, that the your fund manager is supported with AI. Your uh, wealth advisor RI is supported with AI, and even the client is supported with AI. Right. So at all levels of the transaction, AI just becomes an integral part of our lives. So I don't see this as a bubble. I see this as something that is here to stay. Uh, the quicker AI can make progress in explainability, right? The more, I would say, the less black box it is, and the clearer it is. So if I'm a DIY kind of investor and I have a AI assistant that can explain to me the exact rationale for that it has used to arrive at a particular decision, the faster the adoption and I would say eventual, uh, you know, uh, like lack of dependence on RIAs or advisors is, especially for DIY investors, because they actually don't want anyone to help them. They want to do it themselves. They want everything low cost. So since they are motivated that way, and they are willing to, let's say, disregard the 2-3% value add that an advisor may be able to bring, right? They are willing to disregard that, or they think that that never really happens, right? So there is this self belief, or so because of that reason, I think the faster AI can become explainable, the easier it becomes to write prompts to get data. I think the faster that adoption will be, especially on the DIY client side.
Okay.
Gautam, just
Uh,
Neil, I just wanted to ask on this
yeah.
itself. You mentioned right at the start, right, that RI is kind of catered to the 1%, and what Gautam is also referring to then eventually goes back to the same point that the DIY folks continue to leverage technology further. Is there a way to look at it differently, and RIs kind of use AI to maybe expand exponentially, right? Like some of the fintechs are doing. Is that a possibility? I would like to get Harsh's view on this. Do you see that happening within the RI fraternity in terms of trying to adopt more tech, right, to reach more scale?
Oh, absolutely. I mean, there is no question that IA would make the financial planners and investment advisors far more productive, okay? And their ability to handle far more client. It is deep work, right? And therefore, it has some inherent limitations. And I think IA helps overcome those limitations. It helps to take it towards more mass market. I don't know whether it can become completely mass market, but it does definitely helps in taking it towards mass market. And that really is something that has happened with every technology. Okay, I mean, you pick up a technology, right? I mean, none of you were around at that time, but if you remember the debate back in the 1980s when computers were introduced in the banks, okay, there was strike by the bank union saying it will replace, workers, and look what happened. I mean, it got introduced, it got delayed, but it got introduced, and the number of workers went up, not down. Okay, because much more became possible. I mean, that's known as the Jevons paradox, right? When the productivity of coal increased, okay, the ability to use coal more efficiently with the steam engine, etc., increased. The cost decreased, and therefore the usage just went up through the roof. We have seen that with transistors. Okay, there is absolutely no reason why we will not see it with AI. Every day, at least in our group, we hear of a person, coming up with a new use case, and that is true across all professions. So there is no question that the services will become more efficient and therefore more accessible, more democratized. Okay, and again, as I keep coming back, that obviously we will become much better. Okay, we will be able to do that with lot more people. We need the regulators' help in all the three areas that I outlined earlier.
Okay, there are two interesting and related questions on trust. So I'm going to take them together. The first one is about, which says that much of the RIA business works on trust. So how do you see AI handling trust between the investor and the advisor? Second one is about, we all know that AI can simulate empathy, but it can't actually care. In a market crash, do you think clients will actually trust digital reassurance from an AI, or will the premium on human access actually skyrocket because genuine trust becomes scarce?
Yeah,
Harsh,
so
if you like to
maybe
take that. Yeah. So go ahead, Gautam.
yeah, maybe I can take the trust point. Right? This kind of reminds me of when we were talking about, let's say, online shopping, right? And whether people will trust shopping online or whether they will continue to, uh, buy offline. And today, everyone is buying online, right? And I think it is a matter of time before that behavior changes. We would like to believe that people will still want to prefer a person uh, who they can rely on. But I think as the new generation comes in and as the younger people start investing, who are, let's say, native AI users, those people will be quite comfortable delegating this work to AI and relying on AI. So I think we are still some time away from that happening, but yes, till then, trust is something that the what do you call, the Iron Man model is probably what will work till that. So Iron Man is basically, you've got Tony Stark and AI being the suit, right? So the financial planner is Tony Stark and AI being the suit. So you have the Iron Man approach. That model will probably be the hybrid model that will work for some time before you start seeing a lot more clients being comfortable completely on AI, completely AI based robo advisory, and really not looking at people at all. So, but we'll get there, I think.
Gautam, if I might add to that, there are two levels of trust gap, I think, with AI. One is lack of trust on competence. So when we type a question into ChatGPT, we know that there is a chance that ChatGPT will give us the wrong answer. Either it'll hallucinate or the internet itself, I mean, has in a sense the wrong answer because ChatGPT uses the same algorithms, I think, roughly that Google does. It trawls the entire net. So to solve for competence, I would imagine that you and all of the other folks in wealth management would have your own AI models which are trained on specific data, on data that you have filtered. And would love to hear an update from you on that. But the second kind of trust is that of bias or incentives, in the sense that what if the AI wants to earn commissions from you? You just don't know it. Right now, we don't think that ChatGPT is going to recommend an insurance policy because it's going to get 40% commission. It's not in the picture. But you don't know in the future, for example, let's say Grok, which is trained on X, and X has no filters when it comes to extreme political statements. So a lot of people think that therefore that biases the AI in question. So I want to hear your inputs on both these things, competence and bias.
So the bias, like I said earlier, bias can be addressed very easily with explainability, right? So as long as AI remains black box, then no one's going to trust it. But as more and more AI becomes explainable, and you can actually, as a user, test the logic that the logical steps that AI has taken to arrive at a particular decision or piece of advice, that will provide much more comfort to the end user, right? So I think to a large extent, the threat of hallucination can be addressed through explainability. The second point where you're talking about what we are doing internally to, let's say, give us that edge, or how are we leveraging as a large institution, is so Mirae, for example, has bought WellSpot, right? It's a US based company which is completely focused on AI. And we are collaborating with WellSpot, a group company, to figure out how to operate and manage a PMS portfolio, which will deliver above benchmark returns consistently in the Indian market. Right. So now we've come up with a model, and now we are trying to figure out how to. We've got this model. It's not very expensive, right? Portfolio churn is about 80-100%, and it can deliver 5 to 6% above benchmark consistently in back testing. So now we are comfortable with this, and we want to be able to figure out a way to launch it. So should we put a fund manager overlay on it, or should we just run it as it is? Those are the kind of decisions that we are now taking. But the point is that institutions like ours will provide AI-enabled fund management very soon, right? I'm sure all the large AMCs are also looking at how they can equip their, top fund managers, with AI. So all those things, testing and those things are already going on for sure.
Neil, I would just like to add a point there that, trust, there are two things, right? Trust is always reciprocal. Okay. And I think trust is a very human thing. I can't believe that people can trust a, untouchable, something that is a black box, no matter how explainable that black box is. Okay. And trust, I have always found, is very reciprocal in the sense that till I tell the client something about myself, my experiences, okay, his ability to relate to me as a person is not there, okay. And I think trust builds over time, okay. It's a continuum, okay. More you are with a, in a certain relationship, it builds or it gets destroyed. I mean, the trust can also be broken. But the longer the length of the relationship, chances are the trust is higher. And as I said, it can't be a one-way street. The client cannot keep telling you things, okay, and you not tell anything to the client. The client needs to know you as a person. And how do you know ChatGPT as a person? How do you, know Perplexity as a person? So to me, trust is quintessentially human. Okay. And I think wealth management or financial planning eventually will boil down to trust. Okay. And I think that is something that AI is going to have some difficulty building.
No, absolutely. Well said. I think we are almost at the end of our time. If there's no further question, we can probably wrap up.
Neil,
Um,
any closing
there is
thoughts
one.
from you, since you interact with a lot of folks as well, right? We've not had your insights as much. So maybe something from you as to how you think this will shape
Sure,
up.
sure. No, I think Harsh summed it up really well that you can't replace a human when it comes to trust. At best, we will see a lot of hybrid models coming up where advisors use AI assistants to do a lot more work than they themselves can. But ultimately, they have to be accountable. Tomorrow, if I create an AI version of myself and it says something wrong, as long as the client knows he can catch me, he will probably trust it. But if it's just a random model without any person behind it, then it's quite hard to sell.
Interesting.
All
Okay,
right.
I think, yeah. Yeah, Neil, you want to close it out and then maybe I can close it out.
Sure. Yeah, very quickly. So, thank you so much, Harsh and Gautam, for laying out the entire roadmap for how AI can affect finance in different ways. Over to you, Likith.
Yep. Thank you, Neil, Harsh, Gautam. Very insightful and very extensive discussion. So very interesting perspectives as well. Somebody that runs at scale as well, somebody that deals very closely with the client. So great insights. This has helped break down a very complex and sensitive topic, brings out strong emotions. And I hope the audience got it worth their time, right? Thanks. It was great for us as well to host this. We'll be back with another one soon. Thank you. Thank you everyone for joining in. Thanks.
Thank you.
Thank you.
Thank you.
Thank you.